strategy, the stop loss strategy is so important, and I get a lot of people that ask me, why should I actually apply it? Because I've been applying the stop loss, but it's been knocking me out of my shares too frequently, and that's why I have not been using it anymore. So hopefully, once again this morning, I can indulge you a little bit and hopefully convince you to use your stop losses again and make sure that you do apply them, because they are a really important factor. And I've got a practical example for you this morning, but I want to start off right at the beginning and say, listen, what is a stop loss? Now, in our lecture modules, we compare the stop loss strategy to being in a car, right, and wearing your seatbelt. Now, hopefully all of you are wearing your seatbelts when you go out driving, but you would agree with me that you're not going to get into your car in the morning, or you're not getting into your car every day thinking that you are going to get into an accident just as you drive out of your complex or as you get to the first stop street. You're not thinking about getting into that motor car accident. But the safety belt that you put on for in case, just for in case something does go wrong, that you are protected and you are fastened. The same goes to say for a stop loss. A stop loss is there that after you've done your technical and fundamental analysis, that you've applied the stop loss to make sure that if something goes wrong, if there is something that I've missed, that it will protect me against the bulk of my capital, right? So that's the stop loss. And now the main thing is that I found as well is that people tend to invest into shares which does not have enough liquid movement. And you'll notice that this morning that I've got the share filter, and remember the share filter you can find under subscribers. You get the share filter. Now before I go on with the share filter, I want to let you know there's a new feature available under the share filter. It's called the year percentage to date. So this will basically show you the performance of the shares, whether or not shares are positive or negative so far for this year. So please go and check that out as something new that's added onto the website. But my focus is on the share filter this morning, and the reason I want to look at the share filter is because someone starting new in the stock market tends to do one of two mistakes. We talk about this a lot, but timing and selection is two of the main problems that we see. Now, from my side, I found that selection tends not to be the problem. A lot of you that are already on the market or still busy simulating, it doesn't matter, you will tend to buy high quality blue chip shares. You will tend to buy shares that you know that has really good profit margins and things like that. So your selection is normally not the problem. The problem that I tend to find is the timing. Now, timing is directly coupled with your charting analysis or your technical analysis, because on your charting tool, which is this, your charting tool, you do technical and fundamental analysis. Here you go. Yeah, you can see that. So on the charting tool, your technical and fundamental analysis is done, but mainly your technicals. Now, you tend to find that some people tend to buy when a cycle is high or when the cycle is right here at the top. And that doesn't help, because if you make a mistake like that, at least you have your stop loss to protect you. But this is not what we want you to do. We don't want you to buy into a share at the wrong time, right? So one of the major concerns that I have is that people tend to buy into shares that do not have enough liquid movement. Now, this is why I want to start off this morning with a share filter and explain a little bit about the liquidity of stocks. Now, if you buy a share, you need to make sure that there's enough liquid movement. Now, I'm not talking about the profits or the turnover of the company. That's another liquidity. I'm talking about the liquidity of the share. Is there enough movement per day going through the share on a daily basis? Now, if you've got 10,000 Rand or 5,000 Rand or 500,000 Rand, doesn't matter. Whatever the amount is that you say that you are willing to put into the market on a specific share, you need to go and filter and make sure that you only want to be looking at shares that trade above that amount that you have, right? So we call it a rule of thumb, and the rule of thumb is at least 3 times the amount you want to put into the market or put into a specific share should go through that stock on a daily basis, right? So how do you do that? You go to your share filter and you want to eliminate all the shares that does not fall within that particular category. Then you go to traded value. After going to traded value, you say you're looking at all shares trading more than, and let's say we've got 10,000 Rand, so at least 30,000 Rands worth of movement per day should go through that share. So the share filter will automatically eliminate any stock which does not conform to that 30,000 Rand movement. And if you want to increase that amount, right, because you want to be more conservative, if you're one of those persons that are really, really conservative, then you can increase that. If you say, I've got 10,000 Rand, but I want to see at least 100,000 Rands movement per day on a specific stock, then you can do that. You can be a lot more conservative, because being more conservative means that you're going to be working with stocks that has enough liquid movement, which is a good thing. Now, why am I talking about liquidity? Why am I talking about the liquidity of the stock? Because the thing is, if you've got a stop loss on your share and your share hits your stop loss, you want to sell out of that share. But now you've bought a share that's not liquid enough, meaning that there's no buyers for when you want to get out of the share. Now your stop loss basically means nothing to you because you can't get out of that stock. So when you buy a share, there needs to be enough liquid movement. So make sure that you use the traded value filter so that you can filter for the shares and that they have enough liquid movement. Now, getting back to the stop loss, if you're busy making notes, I hope you're making some notes. It's important that you go and read lecture module number 8, the stop loss module. Under our lecture modules, you go to the introductory module, and it's important that you do go and read lecture module number 8, called the stop loss strategy. Go and read that module. There's also a webinar under that, but I'm going to cover most of the things that are said to you in that lecture module, but I want you to go and read up on it. Now, in that module, if you're busy making notes, we say that you should not be risking on your initial buy more than 15% risk. 15%, so 15% risk. Now, your brokerage fees, if you buy a share, tends to work out on about plus minus 3%, right? So plus minus 3% of that you will be paying in brokerage. Now, of that 3%, you need to deduct that from the 15%. Right? If you deduct that 3% from the 15%, that obviously leaves you then with a 12% stop, right, that you can still use. Now, remember, your whole stop loss is still the 15%, but the reason I'm using the 12% is because the 12% is applicable to me on my charting tool when I do my technical analysis. Now, I want you to go this afternoon after the session, on whenever you've got time, that you go and apply your stop losses like I'm going to do this morning on this, because it's important that you see the point of reference of where I should be getting out and how far away is the share price from my stop loss that I know I have on my share. Right, so let's start with the practical examples. Once again, if you've got any questions this morning, you're more than welcome to ask it in the chat box, and I'll try and answer it to the best of my ability. Right, so let's start off with, now you'll notice I've already got the MACD and stochastic on here, because as you know, share tracking, the foundational phase of technical analysis, we talk about MACD and the stochastic along with the 200-day moving average. I'm not going to get into the technicals this morning, but this is how your layout would be if I do technical analysis. Now you'll notice I've got a period of about 3 years here. You're more than welcome to use more than that, 3 to 5 years. Do not, when you do a technical analysis, use less than 2 years data. There's no way that you can determine what the trend of a stock is by using less than that, right? So I'm using more than 2 years data at this point in time, but my main focus for this morning is actually just going to be for the last 2 years, focusing from 2014 up until where we're currently at, right? Now, in this 2-year period, I'm looking at what I refer to as the average gain and the average fall. So the average gain and the average fall. Now you're probably sitting and thinking there, Cornay, why are you talking about average gain and average fall? I thought we were busy with the stop loss. Well, this is exactly it. It's really important that you know the average gain and the average fall that a specific stock does. Now, I've calculated from 2014. If you want, once again, if you want to be conservative, I tend to calculate actually 5 years, but just for this morning, we're only going to be focusing from 2014 up until now. Now, the share that I want to look at is going to be REI, right? It looks something a little bit like this. Now, from 2014 up until now, I've calculated the average fall. So what it basically means is I calculate, let me just get my pencil, right? So I calculate from this point here, right? So from this point here to this point over here. So my main focus is the downwards movement over there. Then once again, I'll calculate from this high, I'll calculate from that high all the way to what this low is over here. And then I'll do the same practical example over here. Once again, doing it over here. And so you can see I'll do this for all the falls because I want to calculate the average fall. Now, I've already done that this morning, but you're more than welcome to do it. The average amount of fall currently for REI from 2014 until now, the average amount of drop is about 9.2%. Now that's really important because if you're calculating a stop loss and you're saying I'm using a 12% stop loss, it means that if I've bought the share in 2014 up until now, I would still be sitting with the share. I would actually not be out of the stock at this point in time because the average amount of fall is about 9.2% and my stop is set at 12%. Now the average amount of gain, this means if you go and calculate all the gains that this share made. So I calculated from this bottom part over here up until this top part over here, or you can even take it further. You can take it from this bottom part up until the highest point, which was over here. But I like to use the first segment. If a share starts to pull back, I recalculate it from this point over here to this point over here. So I calculate the average gain and the average fall because this will help me with my stop loss. Right. Now, if we get into the stop loss part, after I've calculated, the average fall we said, or the average downwards movement is about 9.2. The average gain, if you're making notes, is about 16.1. And this is on the stock. REI is the code of the share. Now, if you've been following Share Tracking's technical analysis process on how you should be analyzing a share for a beginner, if you've done that, let's say we've bought the share. Now I'm going to use a vertical line to indicate the point of entry where I would have then bought the share. So it would have been at this position over here. So that position is the 12th of December of 2013, right? If you've bought the share there, then you need to calculate your stop loss. Now at that point in time, because we look at the technicals, as we've been learned by the foundation phase, Share Tracking teaches you on the MACD, you're looking for specific crossover points. You're looking for a crossover point on the MACD and a crossover point on the stochastic. Now, on the 12th of December 2013, 18th of December 2013, you see this crossover happening on the 18th, right? And that price was 19 Rand 44. Now, if you're asking me this morning, Cornay, how do you know it's 19 Rand 44? If you look to your right-hand side, remember to your right-hand side, you've got what we refer to as O, C, H, and L. That's open, high, low, and close, right? You're looking at the C. I'm currently focusing on this price over here, the C, which is the closing price. Now, on the 18th of December 2013, the closing price was sitting at 1944. Now, that's the price that I've bought the share for. Now you need to calculate the stop. Now I want to, before I move on, I said it in the previous session, I said it at the end, but I actually want to say it in the beginning this time. Please, under no circumstances, think that I'm using a 12% stop loss right through the bank on all of my shares. I do not do that. You need to calculate the risk that each share contains, right? In order to determine the sort of stop loss that I need to use. I've already calculated that the average amount of fall that a specific drop that this share does is about 9.2%. So my stop loss I will use is 12%, because I don't want to use anything really less than that if that is the average fall that a share does. Because if the share drops with more than 9.2%, then I know there's something extraordinary actually happening within the share. Wake you for that. So please, this morning, if you're making notes, you do not use the same stop loss on all the shares. Each share carries its own risk. You need to determine what is the average amount of gain that specific share does in a specific period of time, and what's the average amount of drop that share does. And that will help you to calculate the share's stop loss, right? So if we move on now, let's say we use a 12% stop on the share. So we calculate that. So you take your calculator. So I'm getting really practical this morning, but this is the way that I do it. So you take the 19 Rand 44. That's my buying price. You deduct the 12% stop. That 12% stop is 2 Rand 33. And that will then give me a stop loss amount of 17 Rand 10 cents. Right? Now, if I go back to my chart, and this is why you want to do it practically, you want to go and add it onto your chart. You take your horizontal line, and remember all your lines and everything that I'm drawing with is in your left hand side corner of your charting tool, right? So you go and you get down to 17. I think the closest we got was about 1712. I'll use 1712 as my stop. So this is my initial stop. So since I've bought it, this is my initial stop. So then I make an annotation and I say here, 12% stop loss. And I save that, right? So that's my 12% stop now. So if the share moves down from the position that I've bought it at and it gets down to this level, then I'm out of it, because I've already calculated that's the amount of risk that I'm willing to take. And this is why we use stop losses, because a lot of people buy shares but they don't use a stop loss. Now the share gets down with 12%, and let's say they did place, let's use the example, and you did put a stop loss of 12%. Maybe you can relate to this. Now you've placed your 12% stop loss and you're saying, yes, I'm going to get out of that level, and now the stock gets down to 12%, right? Now, as the share gets down to the 12%, you're sitting there and you're thinking, well, I need to sell the share because I've placed my stop loss at 12, right? And now you keep the share. You say, well, I can't understand. It's going down to 12, but I'm dead sure that it's going to go up next week. And then you found to your dismay that this share actually continues to go down. And then it goes down by 20, 30, maybe even 50% in value. And because you did not get out at that level, you have taken on your portfolio so much risk that your portfolio, or the loss that you've made, was 50%. In order for you to make that 50% back, the share needs to double in value in order to get back to your original price. So it's really important. The psychological idea behind the stop loss is this will help you to force you to say, listen, your share is now at your stop loss. You probably need to get out of it. And this is why I want you to practically go and add your stop loss onto your shares, right? So that's my 12% stop. So now if we go back and let's recalculate it, because now the share starts moving up. Fortunately for us, we see an upwards movement in share price. Now, the next question I get is, okay, Corné, do I need to calculate it every time the share moves up? No, not really. I always calculate it if it makes a relatively new, substantially actually, a new high. So that from that high point, I will recalculate it. From this high point over here, I'll recalculate it. And from this high point over here, I will be recalculating it. Okay, so let's do that. So I use my crosshairs to determine that high level. So on the 27th of February of 2014, the price was 24.39. So how did we say we calculate our stop? So this is what we refer to, if you were wondering. This is not just a stop loss. We refer to this as a trailing stop loss, a trailing stop loss. So the price when it made its new high was 24.39, right? After the 24.39, I deduct a 12% stop that I'm willing to take. That gives me an amount of R2.92. If you want to take the decimals away, you can make it R2.30 at 93, but it doesn't really matter. After I've done that, my stop is now set at R21.46. 21.46. So I go back here, I select my horizontal level, and I select 21.46. Right, the closest we're going to get is about 21.44, which is also fine, right? So now my stop loss has moved up. Remember, a stop loss can only go up. It cannot go down. It cannot move down. It can only go up. So this is what we refer to as a trailing stop loss. From my initial 12% stop, my stop has now moved up to its new level, right? And this new level is set at 21.46. So if the share price touches this line, then it means that it hits my stop loss, and then I will be out of it. But notice that the share does not get down to this level. It actually only gets down to this level over here, right? So as the share then moves on, so it moves from this new high point, it moves on to this new high, and then I calculate my new high point. From that point is then going to be, let me just get down to it, this new high. Let's calculate it, and let's use the last one. You'll notice that this high point, this is now the third time your share. You've bought the share, remember, on the 18th of December 2013, you've bought the share, you've kept the share, it's not yet hit your stop loss, and you're busy recalculating each time it makes a new high. So this is now the third time for this year that the share has made a new, for 2014, that it's made a new high, right? Now you calculate your stop loss again from that high point. So that point is 26.85. And your stop loss that you're going to be using is 12%. So what we do is we take 26.85 minus your 12% stop. That leaves me with R3.22 as being my stop, and that gives it at R23.60, right? R23.63 is our new stop loss level. So I calculate that by using my horizontal line again, and I go down to 23 Rand, and I want to get as close as possible. You're not always going to get on the exact level, but you want to get as close as possible. So 23.61 is also fine. 23.61 is also fine. So you'll notice that my stop loss has been triggered. I hope everyone sees this, that my stop loss has actually now been triggered. So you'll notice at this point in time that my stop has been triggered. Now, as my stop has been triggered, I will now take evasive action and say, listen, that this thing has reached its stop loss, I'm going to get out of it. Now, you're probably thinking, yeah, but then I'm making a loss. You're not actually making a loss. If we take it since the time that we've bought it on the 18th of December, right? If we've taken that percentage up until the point where I'm getting out of the share, I'm still making a 22% gain. I still made a 22% gain. So I've taken the loss. I've seen that the shares retraced back with the 12%, right? But at least I'm still making my 22% gain on the share. So this is a practical example of why I actually use my horizontal levels, because you'll notice that these previous levels actually is not applicable anymore. I can remove them. So my starting one I can remove. We can remove this and that last line. That was my latest stop loss level. It hit my stop loss level and I got out of it, right? I said that I'm not willing to risk it. I will take my 22% gain since the day that I've bought the share up until where I get out of the stock. I've made my 22%. I'm happy with that, and I'm going to get out. So you can see that it's really important that as the share makes new highs, on each high point, I recalculate my latest stop loss, because this is a trailing stop loss. It can only move up. It cannot move downwards, Right. Now I want you to go and practice this on your portfolio as well this afternoon. That you make sure that you do have your stop loss on this. And remember, you've got your annotation available to you. Your annotations are available to you. You can make an annotation saying, listen, this is my 12% stop, so that you at least know what is the horizontal line that you've put on your share chart, right? So at least you know that that's your 12% stop. And I want you to recalculate it each time it makes a new high. Now, also on your share tracking software, along with the stop loss, right? If your share does get down to that value and you need to get out of it, it's really important that you actually add your SMS alerts as well. Share tracking provides you with SMSs that you can put on, and those SMS alerts are found under your simulation, your share tracking simulation, and you can place a stop loss on that. Now, the last thing that I want to talk about this morning is if you've already made a 100% gain or a 50% gain. I get this a lot. People ask me, okay, Corné, but when do you get out? If I've got a 100% gain, do I actually just get out of the share when I made my 100%? How do I know when to take my 100% and leave? The main thing that you need to remember is that if you've made a 100% gain, this is why I calculate the average amount of growth and the average amount of a drop that the share actually does. Because if I know that the average drop that a share does is 9.2%, then I can put a stop loss of, let's say, 15 or maybe 20%. But this is only applicable when I've made a 100 or 200% gain. Then if the share drops by 15% and it hits my stop, then at least I know that I've made my 80% or my 85%, right? And because the share pulled back by 15%, that is something that has not happened in a while. So that's something extraordinary, and that's why I will get out of it. So that's one way of using a stop loss to get out of a stock and take your profits. Now, I've got a question here from Yaku, which asked, wouldn't it be better to manage your stop loss manually rather than an automatic stop loss? And the answer to that is yes. You need to be actively involved. An automatic stop loss, which is, I don't know if you're referring to a trailing stop loss, but or an automatic filter that automatically calculates it for you. It is, in my findings over the years, it's much easier if you've got an Excel spreadsheet or something where you can read the data into, or if you've got, like we do, an SMS alert. It's good to use that because we automatically calculate the trailing stop loss for you. So for instance, if you set up your SMS alerts on our program, we will calculate the stop loss as the share moves up. We automatically calculate it from the highest level downwards, right? The 12% or whatever your stop is that you use. But yes, Yaku, to answer the question, it's really important that each and every client does use and calculate it manually and apply it to your chart. The practical example that we've done this morning is by applying the stop loss levels on your chart. So if you already have shares in your portfolio, your simulation portfolio, even if you have a real trading portfolio, go and calculate your percentages. And yes, it's going to be a manual task and it will take some time. I mean, we've done this, but it only took a few minutes to calculate my stop. So it's not even a burden on me to do that. So go and calculate your stop losses manually and apply them. And remember, if your share hits your stop loss, I get this a lot. People say, listen, if it hits my stop, do I need to immediately sell it? You've got one of two questions that you need to ask yourself. If something hits your stop loss, is the share currently in a bull trend? If it is in a bull trend, ask yourself the question, what is the company that I'm currently dealing with? Is it a high quality stock? And are they showing signs of profits? Are we expecting to get better dividends? If the questions or the answers to those questions are yes, then you can keep the share. But this is normally not a practice that we want to use, because normally if a share hits your stop, it means that you've either done a technical analysis wrong or you've done a fundamental analysis wrong. Your timing and selection was probably off, and that's why it hit your stop loss. Right. So that's all we've got time for this morning. Thank you very much for joining us for this session. On this, I've got one last question that comes through. If there's more questions, you're more than welcome to send your questions through. Can one use the buy and sell signals in the filter area, and how accurate is it? Okay, to answer that first question, the question which was raised by Ian is basically on the share filter, the buy and sells that you see here. Okay, let me just elaborate a little bit on the buy and sells that you see here. These are based on technical analysis on a 20-day moving average, 10 and 20, and a 5, 10, and 20-day moving average. They are accurate because it's basically a calculation, but I will not use it as my indication for a buy or sell. I will never, based on something that's, for instance, we show you buy. This is just to help you to get to the chart, to do a technical analysis. But I will not, because it says buy here, that I will just go and buy the stock. I will still do a technical analysis. So it is accurate because it uses technical data to calculate it, but I will not be basing my buy just on those signals at all. The second question you asked is, and what happened to the share tracking competitions which were held in the past? Well, Ian, luckily for you, we are going to be hosting a new competition coming up in September on the Groot Ontbyt. You'll see that we are on Kyk as well every Wednesday morning, so watch out for that. There's a competition going to be where you need to select some shares, and the best performer will win some cash, so the competitions are definitely there. I've got some more questions coming in from Yaku. What if the normal price drop after the dividend pay? What if the normal price drop after the dividend payout triggers your stop loss? Okay, so what happens, to answer that question, is basically simple by saying that after a dividend payout, we normally see that a share tends to fall by the amount of dividend which is paid out, right? So if a share pays out a 50 cents dividend, we do see that 50 cents drop in share price as well. If that hits your trigger, I want to ask the question, I want to answer your question by asking the question that in what type of share are you invested? If you're sitting within a share that is a good quality blue chip share, the company had really good dividends that paid out. Remember, a share will, the chances of a share dropping after a dividend payout is really good, right? Although you get some stocks that do tend to climb after a dividend payout, which was really good. But if a dividend is paid out, the share normally retraces back. So that's something normal. So I will not really sell my share just because of the share dropping in share price because of a dividend payout. I would rather look at other technical factors. So if that is a trigger for your stop loss, I would rather sit and see what is going to happen. But just to answer your question, if a company has really good financial results, I will not sell the share because it's normal for a share to drop in share price if a dividend is paid out. But I will refer back to my fundamentals. I like fundamentals, so I'll work through the financial sets. If a company has a really good financial set, I will not get rid of the stock. I will basically still sit in it because I know for a dividend to pay out and share price to drop, it's normal. Right, so hopefully, Yaku, that answered your question. Just let me know if that did answer your question. The next question we just raised, can you look at the candles on the same share, and what do you think of it on the candle at the end? Okay, so Yuan wants me to look at the same stock that we've currently looked at, and he wants me to look at the candles. Right, so the first thing, if we look at the candles, and our main focus is currently on this point over here, and he's referring to this last candle that we're seeing over here. Right, so that last candle, based on the movement that we're seeing, one of the key factors is that you would have noticed, Yuan, that the share tends to react on the 200-day moving average. So one of the key factors for me was the fact that it broke through the 200-day moving average. Because there was so much downside, it broke through that level. Now, normally in technical analysis, if a share breaks through its 200-day moving average or a moving average that you've placed on it, we normally expect a trend reversal. Now, one of the factors that I'll take into consideration on this last candle that you're seeing here, we did see that there was some form of positivity in the beginning of the day, right? So you had a positive upwards movement, but it closed down a little bit negative, right? Let me zoom in a little bit. So it formed this doji that you're seeing here, all right? So normally what I would interpret on this candle is there was more downside than there were upside. So there were more bears than bulls at this point in time. Although it didn't really close negative, it basically almost closed at the same level. I think we might expect some upside, some positivity. The markets, we did see the markets are busy rallying again with the S&P making new highs. So based on this share, on this last candle, I am expecting that maybe from this downside that we've been seeing over here, that I can expect this coming week some positivity to get into the share, and it might start picking up. But on Monday's candle will immediately give me an indication on what I can expect going forward for the stock. But I am expecting more upside for the share. So I hope this helps you, Yuan. Just let me know. Ian asking, on financial statements, yes, most definitely, Ian. Going forward, we're a little bit late. We're 6 minutes past the half hour. We're going to finish off with this, with the last question. The question was, is there going to be more webinars in this regard on financial statements and things like that? Yes, there is. There are going to be seminars on how to read financial statements and how to interpret financial statements, also more technical, how to do technical analysis on stocks. So please just go and register. You'll notice on the courses page, so where you register online, you go to services, you select the stock market courses, and this will open up this page for you, and you can register. You'll see all the webinars that are available to you, and we will be hosting webinars at least, well, almost every Saturday morning, and also in the weekdays we've got evening courses that are running. So please go and register for them. So to answer your question, Yaku, yes, we will most definitely be doing a session like that. So I hope this stop loss strategy helped you a lot, and that you will go and apply it on your shares this afternoon. I hope you have a lovely weekend. Thank you very much for spending your time with me, and up until next time, enjoy your day. Bye bye.